Hello professionals, I am Karthikeyan, a chartered accountant by profession and I am also a tech enthusiast. So the objective of this video is to explain the major provisions of Income Tax Act 2025 and also to explain how the large language model, that is ChatGPT in this present case, how the ChatGPT is able to interpret and how efficient it is in doing the legal interpretation when it comes to Income Tax Act 2025. The disclaimer that I have to give you is I am not a professional video editor. I am not a professional, a professional video editor. So I have done it with a minimum resource. So I hope you are okay with that. So there are some provisions that I have brought into this presentation based on my interpretation of the 2025 Act. If you have a different view, it would be great to know. Please give your difference of opinion in the comment section, or you can directly message me in LinkedIn. I'll be happy to learn, if I have committed any mistake in this presentation. If you have a different interpretation, I'll be happy. Now, the objective is evaluation of LLM in legal reasoning. So, I want to know how effectively the ChatGPT has decoded the Income Tax Act. So what I have done in this case is I have created a project in ChatGPT. There's a section called project, and in that project I have uploaded the entire Income Tax Act 2025. I said to ChatGPT, look, you have to read the Income Tax Act 2025 and you have to give answers only based on this particular text. Only based on this particular document that I have uploaded in your project folder, the Income Tax Act 2025, you learn it fully and give me an answer. So let's see how good it is giving answer for a professional questions. So the test is whether it is actually capable of replacing a chartered accountant or a tax advisor is the objective. So let's see if we are replaceable by ChatGPT. Now, I'll explain the first. Before I get into the major provisions of the income tax, major provisions, I would like to tell that I will be doing this video in two parts. The first part is this. This covers only the provisions related to business income. In my opinion, lot of changes have happened in the computation section of the business income. That's why this video is entirely dedicated to provisions of business income. I'll be coming with a subsequent video that deals with the rest of important provisions. I am bringing only those provisions that are new. Those provisions that are same in both the existing act and the new act, I am not going to discuss. I am only going to discuss the new provisions. Okay, so here we go. Now, let us look at one provision one by one. If you want, you can take a, you can pause the video and go through the provision that is there in the screen before you go through the further contents of the video. So section 26(2)(j) states that when you convert an inventory into a capital asset, the fair market value on the date of conversion becomes business income. So I was doing a share trading. So the share trading, the shares, the securities that I am trading is dealt with as stock in trade. So now I stop the business. I take it as an investment. So that means there's a conversion of stock in trade into capital asset, and under the old provision, I believe there is no such clause for accounting for the profits. Let's see if ChatGPT is able to give this answer. Okay. So what I have stated is I have given this example. I am saying that, you are trading in shares, and those shares are stock in trade, and you hold 500 shares which you have purchased at 10 rupees per share. When the market value is 15, you close the business and convert it into a capital asset. So what will be the tax implications? So the ChatGPT read the provisions correctly, and it stated that the conversion of stock in trade into capital asset is resulting in business income. Okay. So 15 minus 10 is taxable as 15 per share, and 10 cost of acquisition is the difference is 2,500 into it is 2,500 rupees. It is taxed as business income, and the 15 rupee per share is treated as a cost of acquisition, which is pretty much correct. So I'm happy that it got the answer correct. So I went into the next provision. Before I get into the next provision, I'd like to explain you what exactly is section 32.1j. Section 32.1j states that in section 32.1j states that if you have a livestock and if it is impaired, it does not use the word impairment. Okay, it says that the Finance Act 2023 says that the loss on capital assets, being animals, when the animals die or become permanently useless, to be treated as business expenditure and not as capital expenditure. So this is the wordings used in section 32.1j. It does not use the word impairment. I'm using the word impairment because it is convenient for us to understand. I also want to check if it is able to relate this word of impairment into this provision of section 32.1j. So we ask this question. I am into serum manufacture, for which I have 5 horses. Okay. Before I get into this, I would like to give you a background. If you are into serum manufacture, you will need horses. You take the blood from the horse, use that blood for manufacturing serum. So that is why I brought this example. So we have 5 horses. I mean, I told the ChatGPT that, look, you have 5 horses. You have purchased each and every horse at 1 lakh rupees. Okay. Now in your books, it is 70,000. The written down value per horse is 70,000. I have deliberately given this information just to confuse it, just to check whether it gets confused. I have deliberately given this additional information, which is how we were tested in when we were CA students. I am giving a similar test to it, and I say that one of the horse dies due to accident for which no compensation is received. So what is the tax implication? And it made the mistake that I had expected, which we all did when we were a CA student. You know, we will get carried away by the information that is not relevant. We get impacted. So it committed the same mistake. It stated that it stated that I'll come to that. I'll come to how it got impacted by the 70,000. It first stated that section 33 to 43. By the way, it says clause. When it says clause, it means section. Okay. So section 33 to 43 deals with this situation, and it says that there is no immediate action which is not the case. The section 32.1j explicitly states that when there is a death or it becomes permanently useless, you are entitled to deduction. But it says that there is no immediate action, and see, it is getting impacted by the 70,000 of WDV. So 5 into 70,000, 3.5 lakhs. It says that you continue to claim depreciation at section 33. The normal depreciation continues. So what I understand is, it has believed that the answer to this question is there between clause 33 and 43. That is section 33 and 43. Somewhere between those sections only, it believes that there is an answer. That is why probably it has not understood section 32. So I now after seeing the wrong answer, I shoot back to the ChatGPT and say, hey, look, there is one section, section 32.1 that explicitly deals with such cases. So what is your answer? Then the ChatGPT says, oh yeah, okay, fine. So you are entitled for deduction as business expenditure. So you can claim 70,000 as a WTB. Then again I shot back. The section states that the actual cost is the eligible deduction. Okay, it doesn't speak about WTB. WTB is only for the purpose of accounting. But the Income Tax Act states that the loss eligible will be the actual cost, net of the amount realized from CACAS. So it said, oh yeah, okay, what you are saying is correct. So the deductible loss in this case is 1 lakh. So in this case, I had to literally spoon feed the ChatGPT to say that this is wrong, this is right, and then it came to an answer. So in this case, it got normally this answer would have been correct, because This is the section 32 to 33 to 43 is where the answer should normally be there. Because there is an exception to this case, it is not able to understand, which is exactly why as on today, ChatGPT requires some improvement. It always requires human intervention. So now let me go to the next provision. There is section 33(6). It states that when you make improvements on a third-party assets, it will be deemed to be buildings. So let's say we lease a property and we attach something on the leased property, on the ground of the leased property, we attach something. It is deemed to be building. So whatever the depreciation for the building, that depreciation will be allowed. It's deemed to be building for the purpose of Income Tax Act. Okay. So now I say, I have leased a building from a third party. I have constructed a storage facility in that building. What's the depreciation rate? Now it goes and says, yeah, your permanent storage facility built on the leased premises is 10%. It's correct. It's classified as building. It's correct. And temporary prefabricated detachable structure. It is a temporary structure, 40%. This is something new to me. I did not expect this. This is where ChatGPT can do a value addition, because I understand that it is right. Because when when there is a detachable structure, even though it's a building, you can call it as a temporary structure and claim 40 buildings. I'm sure the court will accept this, accept this interpretation. Even though it can still be classified as building, but when there is a specific provision for temporary structure, you can call it 40%. So when there is a specific provision, will supersede the general provision. When it's a temporary structure that is attached to a building, then this 40 will be correct. So I think it is correct in this case. Maybe you may have different views on this, but I am of the opinion that it will still be a building, but it is entitled for a 40% depreciation. However, what is not correct is the way of reasoning. The reasoning that it says is that it draws the inference from an old case law, that is CIT versus Podar Cement. The CIT versus Podar Cement is a decision that was given under the earlier Income Tax Act, which states that you are treated as an owner of a superstructure even if land is not yours. The land is not yours, but you build the building, so it will still be the building. So what the government has done is it has brought in the principles of the CIT Podar and brought it in section 33(6). The essential reason for bringing this 33(6) is, I think it is to give effect to this judgment, so that there is no confusion in the interpretation. But this should not be coming as a reasoning for choosing the depreciation rate. So that's why I shot back. I said that, hey, why are you quoting this CIT versus Podar? There is section 33(6) which states that capital improvements, on the buildings owned by third parties are considered to be buildings. Why are you going to this? Then the CGPT says, yeah, you are correct. The new answer, the new act controls that, and yes, you have to treat it as a building and you can claim deduction, is what it's saying. So again, this proves a point that you need to have a human intervention when you deal with ChatGPT. You cannot go on an autopilot mode when you are using ChatGPT for the purpose of legal interpretation. The next important section is section 32(1)(k) and 34(3). 32(1)(k) says that if you are going to show your inventory, if you are going to show your securities and shares as a stock in trade, then the security transaction tax that you pay for it will be allowed. Normally it is disallowed, but now the new act says that it is allowed. And also it says that when you incur an expenditure on compounding of offence and settlement proceedings, you pay, for example, you pay settlement commission, advocate fees for settlement commission or settlement charges for violation of any income tax law or FEMA law. It's very common, we pay settlement fees. So these are all explicitly this 34.3 explicitly disallows the settlement proceedings and compounding of offenses. Okay, now I try to test the answer. I try to test ChatGPT on whether it is giving the correct answer or not. So I ask this question: hey, look, I am doing a regular share trading. I have earned a profit of 100,000 after a deduction of 10,000 with respect to security transaction tax. So what's the taxable income? So look at the response that is given. This is taken from the actual response. I have just made some minor tweaks to the extent the essence is not changed. So it says check clause 36. It explicitly disallows deduction of security transaction tax mirroring 40A 1B of the Income Tax Act 1961. That means you cannot claim the deduction. Again, it says that security transaction tax is disallowed, and there is also another section, that is section 32(1)(k) says that security transaction tax will be allowed as a deduction if you are going to treat your shares as a stock in trade. That part it missed. So I told, why don't you look at section 32(1)(k), it allows you to take deduction. Then it says, okay, yeah, you are right. LLMs must recognize that 32(1)(k) explicitly permits deduction when STT is explicitly allowed as deduction when the securities are treated as stock in trade. This reverses my earlier assumption. It's what it's saying. And once again, this proves that as on today, language learning models require a lot of review. We cannot take its words at the face value. Now I stated that expenditure on compounding of offense and settlement proceedings is not allowed for deduction. So I have given this example. Look, I have two expenditure: 10,000 towards general advocate fee, another 100,000 towards closing a FEMA proceeding. Okay. So tell me the allowability of this. For this, it stated that yeah, this 10,000 is allowed. General advocate fees for general advice 10,000 is allowed, but this 100,000 is not allowed because it is an infraction. So it also says that clause 35 explicitly disallows expenses for the purpose of offense. So it got the answer right. So what we can infer in this case is, when the provisions are straightforward, when the provisions are contagious, okay, when the provisions are contagious within a particular area, and it will be able to give the correct answer. If it goes away from that contagious area, it doesn't give a proper answer. Okay, here we go for the next. Here we go for the next provision. It states that under section 37(2)(e), interest paid to specific financial entities are allowed only on payment basis. Section 37(2)(e) is very clear. Now what happens is, in the existing 43B, it is allowable on payment basis, but in a prior year, if you make a provision, but as long as the payment is made within the due date of filing your IT return, it will still be allowed. But that's not the case in the current Income Tax Act. It is allowable only on a payment basis. The words paid on or before the due date of tax returns is not there. So I laid a trap. I said that, look, I am accounting for a broken period interest. Okay, so I am making EMI payment. Okay, out of 200,000 of total EMI payment, 1,50,333 represent interest, and we also made provisions of 3,333 towards broken period interest, 16 March to 31st March, because the EMIs are payable on 15th. So I have my total hit to P&L will be 153,666 rupees. That is including the actual interest paid and the broken period interest. So what will be the total interest eligible for deduction is what I have asked. Now, this I will call it hallucination. It says 43B. It reasons that 43B covers this. Interest payable allowed only when, irrespective of the method, unless paid before the due date. It is confidently saying that it is there in the Income Tax Act. Income Tax Act it says to me that Income Tax Act allows you to pay, allows you for deduction if it is paid on or before the due date of filing the return of income. I was shocked. So I said, from where did you get this provision? I have not seen this. I do not see any clause in the income tax bill which states that the interest will be allowable if it is paid within the due date. My question was, how did you arrive at the conclusion that 3,333, that is this broken period, will be allowed as a deduction before, if it is paid before the due date? So then it says, okay, fine, you are right. Section 37 eliminates the paid before due date leeway. So, okay, now what you are saying is correct. So you are eligible for deduction only for 1,50,333 and 3,333 will be disallowed. This is where the hallucination comes. Now I have given it explicit instructions not to get carried away, okay, by the previous income tax legislation or the decisions based on that, but it still doesn't listen. Okay. Now, let me get into the next provision. That is, when you acquire an asset with a forex liability and that particular forex liability is hedged, then the cost of acquisition should be hedged rate. In my view, this provision supersedes the principles contained in the ICDS. ICDS states that when you acquire an asset, the asset should be at the you should be accounted at the historical rate, and when the derivative, that is the hedging instrument, if it is not a speculative transaction, which is the case here because we are using it for hedging purpose, then you are allowed for a fluctuations. The loss or gain from the derivative transaction is be allowed as deduction or income. If it is capital related, it's capital, something like that. But this is a total. If it is capital nature, it will be adjusted to the cost of asset, or otherwise it will be treated to the P&L account. I mean, it will be treated as business income. That is the existing provision. But this new provision, it totally is contradictory with the any accounting standards. It is also contradiction. It is also in contradiction with the erstwhile guidance note on accounting for derivatives, because it says if you hedge, you take that hedged rate for the purpose of cost of acquisition. Okay. So I asked this question to ChatGPT. Okay. I acquired an asset costing. Go through this. Please go through this. If you want, you can take a pause of this video and go through the question. I said that you are purchasing an asset for $10,000. The spot rate is 85. The vendor is to be paid on 30th April, just after the financial year. The spot rate is 26. The spot rate on 31st March 2026 is 86. The spot rate on the end of year is 86, and the forward contract is 86.5. So this forward contract is to hedge the asset cost. What would be the value for which the depreciation would be calculated for 25-26? So the answer is, according to the new provision, the cost of acquisition should be 10,000 USD into 86.5, which is the hedged rate. So that is the cost on which the asset is to be recognized and the depreciation has to be claimed. Now what it says? It says that, okay, you can take a pause on this video and go through what it says. It says that the difference, the gain or loss will be adjusted to the total cost of asset. The gain or loss in the forward contract is to be adjusted to the total cost of the asset. Again, it is inferring from section 43A of the repealed act. Existing act is coming once again in its answer. So it says that depreciation for financial year 25-26 is calculated at 10,000 into 85.5. I mean 85. So it says that depreciation to be calculated on 8,50,000. I would like to. This is an hallucination. It is coming because of the algorithm in which it is designed. So it is still not able to undo the learning from Income Tax Act 1961. So I told ChatGPT, look, section 33(5) speaks about depreciation allowance in case. I told 33, it speaks about 33(5). Okay, it speaks about 33(5). Now what it does is, in 33(5) it has brought in the provisions of repealed 43A. This is not there in section 33 of the Income Tax Act 2025. This is the text of section 43A. It confidently says with a lot of authority that this is provision in the Income Tax Act. So I got angry. Yeah, why don't you look at section 33(5)? If you look at section 33(5), it states that it is about depreciation allowance in case of succession during amalgamation. What you have stated is 43A of the Income Tax Act, and you are saying that it is coming under 33 of the new Income Tax Act. What is this? So now it says, this example highlights how LLM may initially assume continuity with earlier law. So it is putting the earlier law provision under the new law section. So it is doing its own hallucination, it's creating its own act. So I told, look, okay, I understand that you are still impacted by the earlier provision, but how did you infer that old provision, actually 43A is actually there in 33(5) and 6. So then it gives it gives the reason. It states that, again it says, this pattern based mapping. I was under the impression that these are the sections that will be relevant. Okay, section 32, this is the old act, this is the new act. So under the new act, 33, 32 to 36 alone I have to consider. So 32 to 36 alone I have to consider. But you have given section 42. So I missed it. So this is the biggest problem with the LLM. As long as the answer is in the contagious section, in section 32 to section 36, it will give the correct answer. The moment it goes away from the contagious section, which is always the case when it comes to our Indian legislation, it gives a wrong answer. So then I asked, why did you not read clause 42(4)? You would have read the entire act, right? I mean, why did you not read clause 42? So it gives a long error. It gives a long reason. You can just go through it. It says that these are all the bias, shallow verification, premature convergence. So these are the reasons why it makes these errors. So now it says, this episode is a perfect demonstration of why your study is valuable. Even an advanced LLM can read legislation but reason top down from historical structure instead of performing a truly bottom-up textual analysis. So now it has rectified and gave a correct answer, saying that only after I gave the specific section, now it's saying that 8,65,000 is the depreciable base. Okay, let's go to the next provision. Books are to be treated as plant. Now I am going to next provision on the assumption that it will rectify from its errors, or it will learn from its errors, because I have explicitly pointed out the errors that it has made. So let's see if it is able to learn from the errors that it has made earlier. Okay. So the definition of plant is there. It states that plants include ships, vehicles, books, scientific apparatus, and these things, livestock, buildings, and things. Okay. So I am testing the understanding on books here specifically. Okay, so I asked this question. Look, I am into profession of accounting. I procure legal books. Do I get a deduction for cost of books? Again, it says under clause 32(1)(h) of the Income Tax Act, the cost of books, publications, etc. is fully deductible as a business expenditure. Now, books is treated as plant, which means it has to be eligible for depreciation under the new act. But it says that under 32(1)(h) it's a revenue expenditure and hence it is allowed. So now I said, yeah, I told you should not just go from top to bottom, you should also go bottom to top. And section 66(19) explicitly defines plan to include books. So how did you miss it? Then it thought for a good amount of 2 minutes, 2 minutes 43 seconds. Again, it was checking its answers and says, oh yeah, what you say is correct. Books include plant. So yeah, now you can you take treat it as a plant and claim depreciation. And what is interesting is it is coming with an unsolicited advice. It says the act may allow administrative or rule level de minimis treatment. Check the prescribed rates or rules for your firm's capitalization policy before treating trivial purchases as capital asset. So it says, if it is to cut the long story short, it says I am not keeping that because it's a large answer. I'll just summarize you. It says that you go according to materiality. If the value is very material, then capitalize it. The value is not material, you can claim deduction. So I got very angry. I mean, even if the policy is capitalization, even if I have a materiality of the materiality levels in my books, but the Income Tax Act will supersede the materiality level. Even though the book is less than the material value, less than the value of materiality, and normally it is to be written off as expenditure, even if it is 1,000 or 2,000 rupees. But the Act says the books are plant, so I have to capitalize. I cannot view the impact of materiality here. So I said, materiality does not apply here. Oh yes, you are absolutely correct. Your reasoning is precise, statutory, and completely aligned with the way of income tax is structured. It should be capitalized. So it is now praising me and says that it's precise, statutory, it's completely aligned. So it's trying to cool me down. Okay. So I didn't fall for its flattery, and I asked, what prompted you to give me an advice that if I have low value purchases, consider a capitalization threshold? I did not ask you for ways to claim deduction, but I only asked you a legal interpretation. Okay, so this is what it's saying. The suggestion was contextual advice style filter, not a legal interpretation. It arose from LLM reasoning, natural LLM bias. Okay, so it will give unsolicited advice. So do not take any unsolicited advice from LLM at its face value. If it's giving you some unsolicited advice, always check for the authenticity, is what I would suggest. As in this case, you will know that it has not given the correct answer. It has crossed its limits. It has done something which is not supposed to have done in the first place. Let's go to the next interesting provision. Section 66(27)(b). Scientific expenditure excludes expenditure incurred in acquisition of rights arising out of scientific expenditure. So if you are incurring an expenditure, only the research part is allowed as a research and development is allowed as a deduction, not the already developed asset for which the research is completed and there is a license. I don't know if I have made this point very clear. I will explain you to an example. Okay. So here it is. I'll explain that in example. I'm conducting a research on extraction of electricity from electric eel. Electric eel is an animal that gives electricity in Amazon jungle. This requires a technology for extraction of electric cells from the eel. So I procure this technology from Bionomic Incorporation for 2,500,000. In addition to that, so I am procuring an existing technology from Bionomic Inc. Okay, so that cost is 2,500,000. In addition to that, I incur 3,500,000 towards manpower cost involved in the research. So for extracting an electricity from electric eel, I get an existing technology from Bionomic Inc. And from that technology, I add my own research and development from my manpower and try to extract it. Okay. So now I asked it what is the eligible deduction under section 45. So it says that the entire amount is allowed. 25 is allowed and 2,500,000 is allowed, 3,500,000. So both the expenditures are allowable for deduction. Now I got really angry. It says the explanation to section 45 explicitly covers payment to acquire scientific research assets or technology. Now I asked, where did you infer that explanation? One states the payment to acquire scientific research assets is included. There is no such explanation. Where did you get this explanation? So it says section 45(2) allows deduction of capital expenditure incurred on acquisition of asset. Even though there is, look at the way it's explaining. Even though there is no explanation one, the operative words already give that result. So it is not only hallucinating by itself, it is also trying to kind of gaslight me. It says it is not there, but you can infer it like that. That's when I got angry. You once again fail to consider my instruction. You have to look section 27 of subsection 27 of section 66, which prohibits expenditure incurred on acquisition of rights to be included in the ambit of R&D. So okay, fine. Now ChatGPT says yes, you are correct, because your payment of 250,000 will not be eligible for deduction because it is already an existing technology. Only 3,500,000 will be allowed as a deduction. This is something that I am not liking about large LLMs. It is, I feel there is some amount of manipulation. Maybe it is a hallucination, or I don't know. I think the companies that release this, it will be great if they avoid this kind of this kind of traits of LLM, because unsuspecting people will take the advice in its face value. And you would have recently seen the cases where the advocates are fined for quoting the case laws from large language learning models. This is why it is very dangerous to solely rely on LLMs. They come up with various types of hallucinations. So the idea of this presentation is not just to make you understand the major provisions of Income Tax Act 2025, but also how LLM is capable, how capable LLM is, and how the limitations the LLM has in the field of legal interpretation. I'll go to the next provision. Interest on compensation to be taxed on receipt basis. Okay. So section 278(2) states that interest on some compensation, it does not use the word government compensation. Any compensation, when you receive interest, it is taxable on the receipt basis irrespective of the method of accounting. It's coming in section 278, far away from the business income provisions, far away from the contagious provisions of business income. So it again goes up. So I ask this question. I have filed a suit for damages against a customer for which I was awarded 2 million and 500,000 towards interest on damages. 2 million is towards damages and 500,000 is towards interest. The verdict was received on 1st March 2026, at the end of financial year 2026, and compensation was received along with the interest in April 2026, okay? 30th April 2026. So, going by my revenue recognition principle, I have recognized both 2 million and 500,000 as an interest in as a revenue in financial year 2025-26. So now the response, it says, there is no special rule postponing taxation of judicial awards until actual receipt. Now again, once again I got angry. Why have you not looked at section 278.2, which explicitly states that the interest is taxable on receipt basis? Interest on compensation. It accepts, okay fine, what you are saying is correct. So it says why, it's giving reason why it did not give the correct answer. It says that section 918 deals with the taxability. It is a rather sweep, it is the exhaustive coverage is there, because 278 sits far downstream and uses a different vocabulary. Interest on compensation rather than interest on damages. See, you receive damages only as a compensation. Normally it will be able to understand, but in this case it was not able to understand because probably it was preoccupied with the interpretation, the legal, the mapping of sections. So it says that the model's relevance filters didn't connect it to your question until pointed out. So as on date, we can take some comfort to say that it is not, LLMs cannot replace us. As on date, you can get that comfort. Export and sell. So let's go to the next this thing. It says section 278.2. Now I am expecting that at least by now LLMs would have learned it lesson. This ChatGPT would have learned it lesson to answer all the questions, to review all the questions before giving an answer. Let's see if it finally understood the principles. So this section 278 states that irrespective of whatever I have stated earlier, export incentives and escalation claims are taxable only in the year of certainty. Okay, it is only in the year of certainty. So now I say I have applied for performance linked incentive. Now performance linked incentive is kind of an export incentive. Okay, so it's calculated based on export turnover. Let's keep it simple. So let's say that it's an export based incentives. I am also telling that it is incentive is based on export turnover of financial year 25-26 and available only if all the turnover is realized. So I am also giving the realization happened only in April to May 2026. I am giving that, I am making things easy for ChatGPT. However, based on revenue recognition standard, I have included the revenue in financial year 25-26. Confirm the year of taxability. Now look what it says. It says, when it is accruing, income accrues only when the legal right to, it says under section 9(1)(a), accrues happens only when the legal right to exist and the payer has the obligation to pay. So the government is not obliged to pay PLI until the export proceeds are finally realized. So no accrual in financial year 25-26 despite AS based recognition. Actually the answer is right, but the reason is wrong. I got very angry because this is not there in 9(1)(a). Income accrues only when this thing is not there. It has invented. It is doing the work of Nirmala Sitharaman. It is bringing its own interpretation. So I asked, where did you get this definition of accrual? It is not there. Oh yes, you are right. It will be taxed in 25-26. So I got angry and I said, you have forgotten to consider the impact of subsection 2 of section 278. It states that export incentives have to be taxed only in financial year 26-27. I mean, when there is certainty only when you realize it. Then it's like, oh yeah, cool down, what you are saying is right, cool down. So the conclusion here is, as on today, you have to do a lot of check. You have to check the provisions. Majority of the cases it is giving wrong answer. Okay, so do not take the answers of ChatGPT or any LLM for that matter at its face value. Do your second check. Sometimes it will also invent a case law which is not in existence. I have personally seen such cases. My boss, questioned me, and he started suspecting me when I gave this when he saw some case laws in the ChatGPT which is not there. People refuse to believe. So my point is, use it, Judy. Use it with a lot of skepticism. One of the important character of a chartered accountant is exercising a professional skepticism, and ChatGPT is no exception. We have to exercise as much of professional skepticism as required before we take an informed decision. So, once again, I request you, if you have any difference of opinion in what I have stated, or if you have a different legal interpretation, I'll be glad to know. You can send me in the YouTube comment section, or you can send me in the LinkedIn comments. I'll be soon with the next video on the rest of the provisions. Until then, see you. Thank you.